welcome to the We Are CEPR series seminar. Okay, we have a wonderful paper today. So the presenter is Talina Sondershaus. Talina, tell me whether I pronounce in a nice way all the names, first of all. Talina, let me say two words, okay, regarding Talina. Talina holds a PhD from the Halle Institute for Economic Research. She got in 2022, so she's a young researcher. She's now assistant professor in financial economics at the Department of Economic at Lund University, and she's affiliated with the central bank, Norwegian central bank. So the paper that she presents today is a paper joined with Katrin Hackenberg of Catholic University of Eichstätt, Ingolstadt, Victoria Klaus, the Karlsruhe Institute of Technology, and Sven Kling by Norwegian Business School. Okay, I hope all the names are right. Okay, I'm sorry for the bad pronunciation in general. So it's a very nice paper that today. It concentrates, the title is Exploring Media Attention to Climate Change, Collateralized Loan Obligation Trading of Brown Loans. So mainly the paper shows the CLO, that them call CLO, that are the main investor in leveraged loans, take advantage of the fact that when media attention to climate change is very high, the loans from firms in carbon-intensive industry trades at a discount. And CLO exploit this price discount by increasing their investment in carbon-intensive industry, even for those CLOs that have signed the environment commitments. So they declare that they have environment commitments. And the investment strategy is stronger, these investment strategy is stronger for bank-affiliated CLO. So Talina and the co-author suggest therefore that there is a potential conflict between the statement, responsible investment per se commitment, and actual investment behavior. So I think it's very nice, okay? And I'm willing to discuss afterwards. I will have some questions for sure. I leave the floor to Talina, and then I ask all the people that are online to please not to write in the Q&A the questions, but to ask directly to Talina while she's presenting. And if Talina is going to gather too many questions, I'm going to stop you, of course, and let her finish the presentation. Talina is going to have 40 minutes, and then we're going to have 20 minutes afterwards for discussion, but feel free to make your questions during the presentation. Thanks. So please, Talina, go ahead with your presentation. The floor is yours.
Thanks a lot for this very nice introduction, and you pronounced all the names perfectly.
Yeah.
So thanks also to the organizers to making space for this paper. I will directly jump into into our motivation. So to keep us all on the same, or to bring us all on the same page, I will start with the definition of a CLO. So a CLO is, as Laura just said, a collateralized loan obligation. And that is a special purpose vehicle that securitizes corporate loans. So CLOs buy corporate loans from banks on the primary market or corporate loans on the secondary market. They package them and they issue debt tranches, so-called CLO notes or asset-backed securities. And I will go more into this institutional background in a minute. But for the moment, let me say that the CLOs are the major player in the leveraged loan market. So leveraged loans are non-investment grade syndicated loans to corporations. So these are the high-risk loans in the syndicated loan market. And in 2021 alone, for example, CLOs purchased around 75% of all the newly issued loans in the leveraged loan market. So from these numbers and from these facts, we conclude that decisions that CLOs take in terms of their investments can have potentially a large impact on the borrowing firm. And that's why it's important to have a look at these players. Now, meanwhile, we can see that asset managers face a dilemma when there is a rise in public attention to climate change. So on the one hand, the main mandate for asset managers is to generate returns for their clients. But then on the other hand, they also become more under pressure to divest. And this divestments could lead to inferior returns. So in this paper, we argue that CLOs are actually less under pressure in comparison to other market participants. And the reason is that the structure of a CLO resembles more a closed-end fund, and the investments are more opaque. And I will also, investments that the CLO is doing are more opaque. And I will also go more into the details of why we think this is the case in a minute. So we asked the question whether actually CLOs have the opportunity to take advantage of media attention to climate change by buying brown assets while other market participants feel the pressure to divest. So in order to tackle this question, we use daily transaction data on CLO trading of leveraged loans. We also have the holding statistics of CLOs, and we merge this data with indices that measure media attention to climate change in newspaper articles. So let me briefly summarize the results. Laura has already given a preview, but just let me repeat. What we find in this paper is when media attention is high, so when the public, when we see a high attention for climate change issues in the public, we find that first of all, brown loans, and I will soon describe what a brown loan is in our setting. Brown loans trade at a discount, so the price for brown loans falls. And we can see that CLOs use the opportunity and they tilt their portfolios towards these industries. So they become, these portfolios of CLOs become browner in these situations. And we can also see that CLO managers that signed the principles for responsible investment, that is a public commitment to take sustainability criteria into account into their investment decisions. They do not behave differently. They equally load up on these brown loans. And finally, we find that CLOs with a bank affiliation tilt more strongly towards brown loans. So this opens up the question of a potentially regulatory arbitrage story, and I will also interpret our findings later a little bit more in this direction. But first of all, so the next maybe half an hour or so, I will be talking about our contribution to the literature. I will give you more institutional background and the reasons for the hypothesis that we are deriving. I will show you our data, results, and robustness checks. Okay, so basically, we think that we can contribute here to three main strands of literature. The first one is asset prices and climate risks. And we can show that an asset price depreciation in the leveraged loan market. So we can show that prices for brown loans drop when media attention to climate change is high. The second strand of literature is concerned with climate risks and institutional investors. And here we can contribute with the analysis of the CLO managers as an institutional investor. And we can see that these managers actively invest in brown assets. And finally, there's a very fast-growing literature actually on the role of CLOs in general in financial markets. And maybe let me point out here just one paper that is the first one. It's called Performance by Cordell and co-authors. This has been published in the Journal of Finance in 2023. And there the authors are asking the question, why do CLOs exist in the first place? And their suggestion is that CLOs exist for regulatory arbitrage reasons. Banks would like to have an exposure to the leveraged loan market. However, this is very costly because leveraged loans are high-risk loans and banks have to hold or have to have a higher capital ratio if they hold leveraged loans. So they prefer to sell leveraged loans to an intermediary like the CLOs and buy back the best tranches of the debt to get an exposure to this high-risk market. So we can show in the context of climate change that CLOs are what we would call natural arbitrageurs, which buy when others are selling. Okay, so let me give you a little bit more background on the CLOs and how a CLO is working. So here on the left-hand side, you basically can see the primary market for leveraged loans. This is usually the syndicated loan market. Here in this graph, I just show two banks issuing each one loan, but obviously, usually it's several banks issuing a loan together. And then what the banks are doing is they usually sell parts of a loan to a CLO. So here on the right-hand side in blue, you can see the CLO, the special purpose vehicle, which has on the asset side this portfolio of corporate loans, and on the liability side, it issues equity and debt tranches. And importantly here is the difference really to a CDO, so a collateralized debt obligation that issues, for example, mortgage-backed securities. And the big difference here is that the CLO actively manages this portfolio of loans. In contrast, a CDO has a stable or a static portfolio of mortgage loans, whereas the CLO trades actively on the secondary market. And this is actually exactly what we observe in our data. We can see what do CLOs buy and what do they sell on a daily basis. Okay. In general, we can see that this market is not only big, but it's also growing over time, and it has not vanished or completely collapsed after the financial crisis. So here you can see CLO assets under management over time, and this has been growing, and now there are almost $1 trillion US dollar assets under management with CLOs. So just to emphasize the importance of the market. So in this paper, first of all, we have this hypothesis that prices of brown loans trade at a discount when media attention to climate change is high. This is the first hypothesis that we want to test. And the second hypothesis is that CLOs take advantage of these discounts by purchasing more of the brown loans. Now, the reasons why we think that CLOs can do this is basically characteristics of the structure of a CLO, which might shield them from public attention to climate change. So first of all, they are non-bank entities that are less in the public focus in contrast to banks, for example. Then CLOs have only institutional investors. So this is really in contrast, for example, to loan mutual funds. And I will show you at the end, if time allows, also some results for loan mutual funds, which have also retail investors. But here we only have institutional investors. And the investments are more opaque than those of bonds or stocks. So the loans that CLOs invest in, it's not very transparent what's behind that. And investors, importantly, cannot withdraw at short notice. So there is actually a period where the CLO, which is so-called the non-call period, and the CLO is shielded from investor withdrawals. Okay, so the data that we're using in this project comes from Gravelux, and it's called the CLOI dataset. And as I said, we can observe daily loan transactions. So we can see purchases and sales. We only use the data in dollar denominated. In this graph, you could just see that this is the largest share of the market is in dollar denominated. However, we can also see CLOs that trade euro denominated loans. We discard them for the moment and did not have a look at them in this project. We have around 1,900 CLOs, and every CLO is managed by a manager, and we have 172 different managers, and we can see around 1.4 million transactions. The time period of the data that we have at hand is from January 2010 until December 2019. And most ratings of the loans that are being traded are below investment grade. So these are really high-risk loans. And then we also have data on CLO holdings. This is on a quarterly basis, and we also make use of this. Now, I think a big challenge here is, and it's a challenge that also other researchers are facing, is how to define a brown loan in this context. Which firms should we consider to be more environmentally friendly or not? So basically, we use two alternative definitions in this paper. The first one is very easy and straightforward. So we are using industry classifications from Bolton and Kaspersky. And Bolton and Kaspersky in their JFE paper from 2021 report a ranking of industries which have the highest, which report the highest emissions, scope 1, 2, and 3. And we try to merge our industry identifiers. We have Moody's industry identifiers. These are not the same as Bolton and Kaspersky's, but we try to still match them. And we define that loans coming from the following 8 industries to be brown loans. So this is automobile, mining, steel, chemicals, oil and gas, containers, cargo, transport, personal transportation, and utilities. According to this definition, then we have 18.5% of brown loans. However, I guess a major critique is that there's substantial within industry variation across firms in terms of how to think about a brown firm or not brown firm. So we try to get to a little bit more granular level here. So the second definition that we are using, we call this the IGIER definition, is to use refinitiv carbon emission data. However, the problem is that the majority of the firms in our data are actually private companies. So only 14% are public, and we do not have emission data for around 85% of the firms. What we do instead is, at least we try to produce still a more granular definition of what is a brown firm. So what we do is we generate our own ranking with a more granular industry identifiers. So we can match 85% of the issuers with IGIER to obtain so-called activity of the firm. Here we have almost 500 different activities that a firm can have, and we are able, as just said, to match around 85%. And then what we do is we calculate our own industry ranking by using total industry emissions and emission intensity per year for all the firms that we can observe in this data set, and then yearly sort in quintiles based on total emissions and emission intensity. So we can see whether our firm, in which quintile is our firm in terms of emissions of other firms that perform the same activity. So according to this definition, we find in the highest emission quintile the following brown activities. So this is a little bit similar to the industries that you've seen before here. However, a firm can perform one of these activities, which is then, is not in a brown industry according to Bolton and Kaspersky. So it's a different variation that we are exploiting here. So then we also have similarly containers, packaging, etc., oil and gas, metals and mining, and then different types of utilities, which we consider to be brown. Okay, then after defining what is a brown loan, we need to have also a definition of what is a phase of high attention to climate change. We are using for our main analysis a index created by Engle and co-authors, published in the RFS. This is called the Crimson Hexagon Negative News Index. So what Engle and co-authors are doing is that they search for the keyword climate change in 7 different newspaper outlets with textual analysis. So among them are, for example, the Wall Street Journal or BBC and the New York Times, etc. And then they also do a sentiment analysis to filter out or to get to the negative news about climate change. And here you can see the time series of this index. And with red, I marked instances where the index is above its 80th percentile across the whole time series. And you can see that this is also connected to a certain event when climate change was more prevalent in the newspapers. In robustness checks, and if time allows today, I will also show you results for using other media attention indices. Okay, so let me jump right into the first set of results. So first of all, we are looking at prices. So here in this regression, you can see on the left-hand side the price of loan L from industry R traded by CLOI at day T. So here we remain on the daily level. In the next step, we will go to a monthly level. And what we are interested in is whether loans from a brown industry, so that have a brown identifier that is 1, whether they trade at a different price when attention to climate change in the previous month was high. So this is a binary variable here, attention, which is 0 or 1, depending on whether the attention in this index is above its 80th quintile. And in this graph, I show you different definitions of high attention. So we go from if we would only define the first quintile as a period of high attention, which is obviously not a period of high attention, to above the 5th quintile, we can see that already from the 4th quintile of high attention, prices drop for brown loans in comparison to non-brown loans. We can also have a look at the results in a table here. So here in the first 3 columns, we compare brown loans versus all other loans, and we can see a substantial discount here. Prices in this data are reported as % of the notional amount. So you can see here the mean dependent variable is 98.68. So on average, loans are traded at a discount. And if it's a brown loan, then it's traded at a further discount when attention to climate change is high. And we also compare brown versus only green loans. So we also try to find a definition what is a green loan in this context. Okay, so we can see that there's a discount for brown loans. The question now is whether CLOs act and buy and benefit from this discount. So in order to measure tilting of CLOs, we use a measure that we call net purchases of brown loans. So this is a variable that we define on the CLO level I. So it's a CLO I that trades loans from industry R at month T. So now we are on the monthly level. And we define net purchases as the notional purchases that CLOI is doing in industry R at month T minus notional sales, and we normalize by the deal balance in the previous month. Now, when we use this dependent variable, the nice feature about this is we have several time series per CLO, namely for every industry, we have 1 time series, and that allows us to control for CLO time fixed effects. And that was very important from the beginning because CLOs face complex incentives and constraints. So CLOs have, for example, they have constraints concerning the industry concentration, so they must be diversified to a certain extent, and they also have quality constraints. So if a loan, if the rating drops below CCC, they have to sell. And because of these constraints, we all the time want to control for CLO time fixed effects. The mean, to give you a feeling of this variable that we constructed, mean net purchases is 0.2212%. That means CLOs purchase more than they sell. And that makes sense because CLOs reinvest proceeds from loans that mature, as well as actively selling and buying. So on average, CLOs buy more than they sell. Okay, so let's have a look at the results here. Now we have net purchases of CLOI trading loans from industry are in month D as the dependent variable. And again, we are interested in this interaction between measuring media attention to climate change in the previous period interacted with an indicator whether these are net purchases of brown loans or not. We include CLO time fixed effects and also industry fixed effects. And we cluster on the CLO and on the time level. Okay, so when we look at the betas here, we can see that, again, we have a positive coefficient that is significantly different from 0. When attention to climate change is high in the previous month, CLOs increase net purchases of brown loans in comparison to all other loans. To put this into relation in terms of the size of the effect, we can see that this coefficient here corresponds to around 25% of the mean of the sample mean. So CLOs increase net purchases of brown loans by around 25% in comparison to the whole sample. When we compare now brown versus green loans, we find that the effect is even substantially larger. Now I show you also the results for our alternative definition of what is a brown loan. Here, we need to construct a dependent variable a little bit differently because we have these quintiles that I was talking about before. So now we only have 5 time series per CLO if it was invested in all quintiles. So we aggregate net purchases on the emission quintile, so to speak. And here in the first 2 columns, I show you results when we use quintiles measured according emission intensity of all the firms in this respective activity, or column 3 and 4, we use the measure of average emissions. In both cases, again, we find a positive coefficient that is significantly different from 0. And also in terms of economic magnitudes, if we would calculate now to jump, for example, from the lowest to the highest quintile, we find similar results than if we compare green versus brown in the previous analysis. Now, I was talking a little bit about the PRI managers. So the PRI is the Principles for Responsible Investments. This is a leading or the leading initiative for institutional investors to show if they want to publicly show a commitment to incorporate ESG issues into their investment process. So there were in 2022, there were more than 5,000 signatories. And we were hypothesizing when we started this analysis that CLOs whose managers signed Principles for Responsible Investments, that they do not increase net purchases of loans to brown companies when attention to climate change is high. If we would find the opposite, we would interpret this as a hint towards greenwashing, to use this statement just to look good from the outside. So what we do is we do a triple interaction here. The indicator PRI equals 1 if the CLO manager had signed the PRI in the previous month, or had signed it sometime before but is a signatory. And in the first line, you can see the previous result. So attention times brown is again positive and significant. And in the last line, you can see that when we interact with the PRI, there's absolutely no difference across PRI managers and those that did not sign. So it doesn't matter whether a manager has signed the PRI or not. They are increasing the exposure towards brown loans when attention to climate change is high. Secondly, we are interested in another heterogeneity, which is motivated actually by this paper by Cordell and co-authors in the Journal of Finance, which claim that CLOs are used for regulatory arbitrage. So we want to know whether CLOs that are affiliated with the bank behave differently in our context. So 28% of our CLO managers are affiliated with the bank. So one example is the CLO manager First Arrows managers. So we can see always the name of the CLO manager. And so we hand searched for whether these managers have an affiliation with the bank. And First Arrows manager is part of the Rothschild banking group, for example. Now, CLOs are part of an intermediation chain that allows a bank to offload corporate loans and allows it to regain exposure by investing into CLO debt. And as said, this is also what Cordell and co-authors claim to find. Now, we were interested now to see whether CLOs whose managers are affiliated with the bank increase the net purchases of brown loans more strongly than CLOs that are not affiliated with the bank. So in this case, we have a triple interaction with an indicator whether our CLO is affiliated with the bank. So again, in the first line, you can see the previous results, which become a little bit smaller. So the coefficient decrease a little bit when attention to climate change is high. CLOs tilt their portfolios towards brown loans if they are not affiliated with the bank. But if they are affiliated with the bank, you can see the result in the last line. Then we can see an even more pronounced tilting towards brown loans. So we can see that in general, CLOs do this. So they increase the exposure to brown loans, but those CLOs affiliated with the bank, they do this especially strongly. And we would suggest, or we interpret in the paper, that this is also a hint towards regulatory arbitrage, that for banks, it's kind of better to get rid of brown loans and then rather get an indirect exposure via CLO debt rather than holding these loans themselves. Okay, I think I still have a little bit of time, so I will present to you also a few robustness checks and further analysis that we've done here.
Yes, Talina, you have 7-8 minutes, so you can go ahead.
Nice. Okay. I've been talking a lot about these CLOs here now, but in this market, there are also other market participants. So the second largest player in the market are so-called loan mutual funds. And but there are some differences across CLOs and loan mutual funds. So in contrast to CLOs, loan mutual funds are open-ended funds in which investors can withdraw their capital on a daily basis. So we were interested in whether we would find that loan mutual funds actually are the ones that sell when CLOs are buying. So for this purpose, we obtained data on the holdings of 57 loan mutual funds. Unfortunately, we do not have this data for the whole time period, but then luckily around the Paris Agreement, which many researchers actually have used as a shock to public attention of climate change. So we can observe actually whether loan mutual funds change their holdings around the Paris Agreement. So in order to measure in this context a brown loan, we also use these definitions, these 5 emission quintiles based on icon industries. And we are able to find also these icon activities of the holding of the loans that these loan mutual funds are holding. And to measure a rebalancing of holdings or to come as close as possible to this definition of net purchases of the CLOs, we look at the changes of the position weights of these 5 emission quintiles per loan mutual fund. And so what we did in the following, we repeat our analysis, but this time we just look at pre-post Paris Agreement, and we repeat this first for the CLOs to see whether we find also in this particular time period a change of net purchases. So you can see here in the first 2 columns CLOs around the Paris Agreement, and we can see that again the beta coefficient here, which measures pre-post Paris Agreement, depending on which category in terms of emissions we are looking at here. Trading of CLOs, and we find again a positive and significant effect on net purchases of brown loans in comparison to non-brown loans for 1 month before and after the Paris Agreement. And when we then look at the loan mutual funds, we find exactly the opposite result. So we see a negative coefficient here, meaning that loan mutual funds seem to sell when CLOs are buying. We provide more robustness checks in the paper. So, for example, we vary the definition of what is a brown loan. In terms of this first definition, where we use the 34 Moody's industries, where we define 8 brown industries, we exclude one by one every brown industry from the definition brown and include one by one every non-brown industry to see whether if our results depend on one single industry particularly. So we have 168 regressions here, and we plot the results in this histogram. And what we were expecting when we were setting up this robustness check is that we are expecting that on average, the effect should be tilted towards 0, but not too far. And this is actually what we are seeing. So the black line here is the coefficient that we found in our analysis, and most of the results lie towards the left-hand side. Note here that here are also 4 regressions, which resulted in almost 0. And the reason is that if we include the industry electronics and assume it's a brown industry, then the result becomes almost 0. And the reason is that most researchers would consider electronics actually to be really a green industry. And that's why we can see the decrease of the coefficient here. What we also do in the paper is we use other definitions of how to measure media attention to climate change. So we not only use the Crimson Hexagon News Index, which you can see again here on the in the first line, but we also use the Wall Street Journal Index. This is also developed by England authors, published in the same paper, and also the MCCC, so the Media Climate Change. Oh, now I forgot what MCCC is standing for, but it's another index to measure media attention to climate change, this time by IGIER and co-authors, published in Management Science. And what we do here is we identify periods where all 3 indices actually spike. And you can see this marked in gray. So we repeat our analysis. Instead of using the Crimson Hexagon News Index on the right-hand side, we use an aggregated version of these 3 indices to make sure that attention intensity is really high. And again, we find the same results of a positive effect on net purchases. Finally, we also investigate whether CLOs reverse their trades. So what we do is we just introduce lags of our interaction term on the right-hand side. As described before, we measure attention in the previous month. Now we introduce also attention to climate change 2 months, 3 months, or 4 months ago. And if CLOs would reverse their trade within these time periods, we would find a negative effect on the lags. So after purchasing, they might be selling, but we do not see this. So it seems like they are rather holding onto these brown loans. Okay, so let me conclude here. The main takeaways from our papers are that we find, first of all, that prices for brown loans for these leverage loans drop when media attention to climate change is high. We can see that CLOs tilt their portfolios towards brown loans. And this is also true for CLO managers that signed the PRI. And we find a especially strong effect for bank-affiliated CLOs. And maybe to draw some broader conclusions from this, we think that we find hints here for greenwashing activities. Asset managers such as BlackRock, for example, announced publicly to join forces against climate change by signing the PRI. But actually, they have this possibility, and we have BlackRock as an asset manager in our data. They can load up on brown loans, which is not so obvious and not so easily to be seen by the public. And our results are in line with what Cordell and co-authors suggest that CLO exists for regulatory arbitrage. So we conclude that we can see that CLOs are actually natural arbitrageurs that buy brown loans when others, like loan mutual funds, have to sell because public attention to climate change rises. So thanks a lot.